What happens when one of the world's most critical energy choke points becomes unstable? And can alternative routes realistically absorb the pressure? One figure defines the risk. Disruptions in the Strait of Hormuz could push global oil prices toward $200 per barrel, affecting supply chains far beyond the region. This video examines how rising tensions are forcing governments to reassess global trade routes, why attention is shifting toward the Strait of Gibraltar, and what it would take for new infrastructure to alter long-standing logistical dependencies. If this situation escalates into sustained disruption, the fundamental change would be a reconfiguration of global energy flows. Countries dependent on Gulf exports would face supply constraints, while shipping routes would need rapid adjustment. If tensions stabilize, existing patterns through Hormuz are likely to remain dominant, with alternative routes serving only as contingency options. If partial disruptions occur, trade may gradually diversify, accelerating investments in corridors such as Gibraltar, without fully replacing the existing system. Each outcome influences not only energy markets, but also infrastructure planning and geopolitical alignment. To understand the stakes, it is necessary to examine the structure of global maritime trade. The Strait of Hormuz handles a significant share of the world's oil shipments, linking producers in the Gulf to markets in Asia, Europe, and beyond. Its geographic constraints make it both efficient and vulnerable. Any disruption, whether through conflict or blockade, immediately affects supply expectations and pricing mechanisms across global markets. This vulnerability has long been recognized, but recent tensions have intensified the urgency of finding alternatives. One such alternative is the Strait of Gibraltar, the only natural maritime link between the Atlantic Ocean and the Mediterranean Sea. Approximately 300 vessels transit this corridor daily, making it one of the busiest shipping routes globally. Before the opening of the Suez Canal in 1869, Gibraltar served as the primary gateway into the Mediterranean, underscoring its historical importance. Today, its strategic value is being reconsidered in the context of potential disruptions elsewhere. Recent developments have drawn attention to this corridor. Tracking data indicated that the USS Gerald R. Ford activated its public tracking beacon while approaching the Mediterranean gateway, an unusual step during operational deployment. While such actions can have multiple explanations, the visibility of this movement highlights the continued strategic relevance of Gibraltar in military and logistical planning. It also reflects how naval deployments intersect with broader concerns about maritime security. Parallel to these developments, long-term infrastructure projects are gaining renewed attention. Spain and Morocco are advancing plans for a subsea rail tunnel beneath the Strait of Gibraltar, intended to link Europe and Africa directly. The concept dates back to a 1979 agreement signed in Fez, but progress has been uneven due to technical and financial challenges. Recent studies have revived the project, with a detailed blueprint expected in the coming years and potential approval as early as 2027. The proposed tunnel would span approximately 42 kilometers, including about 27 kilometers underwater, connecting Punta Paloma in southern Spain to Cape Malabata near Tangier. Designed to carry both passengers and freight, it could reduce transit times between continents to roughly 30 minutes. Cost estimates range between $15 billion and $20 billion, with Spain's share alone exceeding $8.5 billion. These figures illustrate both the scale of the ambition and the financial commitment required. From a logistical perspective, the tunnel could reshape trade flows by positioning North Africa as a direct link between African production centers and European markets. This aligns with broader economic frameworks such as the African Continental Free Trade Area, which aims to enhance intra-African trade and integration with global supply chains. By reducing reliance on maritime routes, the project could provide an additional layer of resilience in the face of disruptions. However, the engineering challenges are substantial. Earlier plans for a bridge were abandoned in 1996 due to extreme environmental conditions, including depths reaching up to 900 meters and heavy maritime traffic. Current designs focus on a deep rail tunnel routed through the Cameronal Sill at approximately 475 meters below sea level. Engineers must address unstable geological formations, including rock and clay layers, as well as seismic risks associated with the Azores-Gibraltar fault line. These factors increase both complexity and cost, requiring advanced construction techniques and long-term structural resilience. Two scenarios illustrate how these developments could evolve. In the first, prolonged instability in the Strait of Hormuz accelerates investment in alternative routes. Governments and private actors may prioritize infrastructure projects like the Gibraltar Tunnel, expanding capacity and integrating rail and maritime networks. Over time, this could reduce dependence on a single choke point, distributing risk across multiple corridors. In the second scenario, tensions in Hormuz ease without major disruption. In this case, the economic rationale for large-scale alternatives may weaken, slowing investment and delaying projects. The Gibraltar corridor would continue to play an important role, but primarily within its existing capacity rather than as a transformative alternative. The tunnel project might still proceed, but on a longer timeline, driven by regional rather than global considerations. The geopolitical implications extend beyond trade logistics. Control and access to strategic choke points have historically shaped power dynamics, influencing both economic and military strategies. A shift toward diversified routes could alter these dynamics, reducing the leverage associated with any single corridor. At the same time, new infrastructure creates its own dependencies, introducing fresh considerations in terms of security, governance, and coordination. At a structural level, the situation highlights the interconnected nature of modern supply chains. Energy flows, maritime routes, and infrastructure investments are closely linked, with changes in one area affecting multiple sectors. The emergence of alternative corridors reflects both technological capability and strategic necessity, driven by the need to manage risk in an increasingly complex environment. The central issue is not simply whether new routes can replace existing ones, but how quickly they can be developed and integrated into global systems. Observers should watch for indicators such as project approvals, financing arrangements, and construction timelines, as well as shifts in shipping patterns and energy markets. These factors will determine whether the current interest in alternatives translates into lasting change. As this situation evolves, it raises broader questions about resilience and adaptation in global trade. The balance between efficiency and security is becoming more prominent, shaping decisions at both national and international levels. What emerges next will depend on how governments, industries, and institutions respond to uncertainty, and whether they prioritize continuity or transformation in the face of potential disruption.